This is Ron Lang with Atlas Wealth. We are going to do a compressed version of our webinar that we did on the fiscal cliff and tax implications. So, quick introduction. We are going to cover some of the basics of the fiscal cliff, what strategies you can apply, some predictions. Then we're going to make both a bullish and bearish case for moving forward, and then present you some interesting facts. Quick disclosure, all information presented in this webinar is for education purposes and should not be construed as recommendations for your portfolio. The information and content should be intended to better understand the basics of how the markets operate, some investing practices and risks that are involved with investing any money in the markets. Atlas Wealth Management is an investment advisory firm that helps their individual, family, and corporate clients invest to help to build wealth and preserve capital. So if you want to read some of the details here, you can always pause the video. It's important for you to understand that we are not brokers, we are investment advisors, and we have both a strong, very strong suitability and fiduciary duty towards our clients, which means we must put our clients' best interests first before our own. We get involved in some other areas such as corporate retirement plans, trust wills and estates, so on and so forth. We are not attorneys, but we will get involved in some of the content for those trust and estates. We do have market commentaries that go out twice a month, some additional research reports. There'll be an email at the end that you can send a note to in case you want to receive these on a regular basis. So what is the fiscal cliff? What does it contain? Basically, there's going to be 1.2 trillion in automatic cuts in both domestic and defense spending as of January 1st. Essentially, it will be the equivalent of removing $600 billion from the economy. Some economists have already determined that if this happens, our GDP will contract for at least 2 consecutive quarters. Hence, that would be the definition of a recession. So one of the big pieces to the fiscal cliff happening, if it does, is the dividend tax rate. Currently, it's 15%. If it expires, it could go as high as 39.6%. If you have these stocks and ETFs in your retirement accounts, they won't be obviously affected. But for many of you that are just generating income outside of your retirement accounts, especially the retirees, you will be drastically affected by this. So we're hoping that the tax rate will stay probably between 15 to 20%. We'll have to see how all that pans out. Then we have the capital gains tax. It's currently 15%. It could go as high as 20%. It should be interesting because this has been one of the possible political footballs in the whole debate, but we think that it'll probably stay somewhere in between 15 to 20%. If you're making more than $200,000 or more, or if you are married and making $250,000 or more, you will pay an additional 3.8% for the new Medicare tax, which is the Affordable Health Care Act known as Obamacare. This is a big one, the estate tax exemption and maximum rate. Right now, if you can now pass on through your estate $5.12 million, and anything over that would get taxed at 35%. If it expires, then you will only be able to pass on $1 million of your estate, and anything over that would be 55%. So a lot of people are looking in the trust, talking to attorneys to see how they can protect themselves, their money, and pass on to their next generations the best way to do this. I'm not going to go through all this. You can pause the video and look at it in more detail. But this is how the federal marginal income tax rates will change based upon your income. Obviously, the more you make, the more you'll be affected. So what strategies can you apply? Well, there's nothing wrong with going to cash, folks. If you are emotionally affected by this every day, every week, you're better off going to cash and sitting on the sidelines temporarily. Go to lower risk dividend plays until the dust settles early next year. Even hold on to lower risk positions and look for other opportunities in January. As far as it comes to fixed income or bonds, try not to go over to 40 to 45% in your portfolio allocations. Interest rates are very low. They're only going to go in one direction. So if you are going to be in fixed income and bonds, make sure you stay in short term, 3 to 5 years at the most, until we see what happens with interest rates in 2013, 14, and beyond. As far as when it comes to risk, everybody wants no risk and high reward. So one of the things that we do to help our clients with their portfolios is to basically put a percentage of that investment money into moderate to low risk stocks and ETFs so you can garner moderate low reward to high reward. And how do we do that? Well, we want to look for things that obviously are a low to moderate risk that have good dividend payouts. And while we do that, we want to reinvest those dividends on a regular basis, albeit on a quarterly or a monthly basis. So through dollar cost averaging and consistent contributions, you're going to build wealth over time. The best way we can say it, sometimes the merry-go-round investment strategy is better than the roller coaster investment strategy. And the other reason why you just don't want to put the mattress under your bed in the CDs and in the treasuries is because you're going to get less than 1%. And if you're going to get less than 1%, with the price of inflation, that money is going to be less actually in a year or two down the road than if you actually put it into something with a little bit of a higher yield. So before all this fiscal cliff business kind of came to light, we had a basic diversification strategy, and obviously all this is going to depend on your age, your life stage, and your risk tolerance. But what we're looking at here is until that comes about, this is how we've been recommending people reallocate their portfolios. So if you have a larger portfolio and you want to keep a percentage into speculative stocks, that's fine. But you really want to focus more into the fixed income and the income generation. So one of our predictions was that there would be a 50% chance that the fiscal cliff would be resolved by Thanksgiving. That's not going to happen, but at least last week on the 19th, on the 16th, we actually got some type of conciliatory reconciliation to getting much closer to a resolution with this whole fiscal cliff. So it's going to be about another week and a half. They're not going to be back until after Thanksgiving. But between now and then, they're trying to put pen on paper here, outline a few things. So because of that, we definitely believe there's going to be a 90% chance of some type of an amicable resolution by Christmas. In my heart of hearts, I cannot believe it's going to go beyond that. Nobody wants to go over the fiscal cliff and really be that much more damaging to the American investor psyche. Another thesis was that they might put the decision off for 6 to 12 months. I think that's less likely at this point. Bull market case, uncertainty will be removed from the market. There are trillions of dollars of corporate cash on the balance sheet. They have to put the money to work somewhere. R&D, M&A, hiring. With the pre-election polls with CEOs, they weren't doing anything with their money. They were holding off to see who was going to be elected and whether or not the fiscal cliff will be resolved and how it will be resolved. And what it comes down to at this point is they already know who's going to be president for the next 4 years. And if they're able to resolve the fiscal cliff issue, well, then now they can start to put money to work again in places that they feel would be best. Bear markets typically last 3 to 5 years. It originally started in early 2008, maybe 2007, depending on how you want to look at it. So maybe this is the start of a new bull market. For all of you that are still growling out there, the bear market case, we understand also. The Dodd-Frank might restrict financials from making greater profits. Obamacare will be seen as an additional expense for businesses. You could read the rest. But if we do go over the fiscal cliff, the U.S. will most definitely be in a recession, which means that the EU will probably be in a depression. So if we take a look at some facts here, the first year after a presidential election is typically a down year, 19 to 24 years. But this is how the last 8 presidents fared after they won a second term in their first year. And most of those years were down too. So we'll have to see how this plays out, because this being the end of a bear market, very similar to where Reagan was in 1984, we can certainly see an increase here in the upcoming year. So in summary, you want to take a look at the psychology of the markets. You have to have a longer term view, understand your risk and your life stage, understand how the different aspects of the fiscal cliff will impact you. You can listen to all the analysts and pundits out there, but it might not be affecting you. Talk to an attorney about setting up a trust, and be cognizant of market headwinds. So if you have any questions, you can email us, or just email us and we'll put you onto our email list to receive our market reports and our research reports on a regular basis. Thank you for attending.